there's two big misconceptions about private equity. Okay. Number one is that these private equity sponsors are great operators. Lehman Brothers, AIG, Bear Stearns, they all blew up because of mortgage backed securities. That's where my expertise was. It's totally absurd that a couple of Ivy League educated business school grads are going to run a business better than an operating family has been running it for 40 years.
Even the cash flow multiples for the smaller guys are like becoming like 5-6x now, even at the smaller end, and it's like just so arbitrary.
So I think it's important that your listeners understand that the changing tides of private equity and how they impact the capital structure when the business gets acquired. Elegant solutions have simplicity to them.
All right, welcome back to another episode of the ShareWillow podcast. My name is Ryan Shank, founder of ShareWillow. Today, super excited here with Jim Richer from Monatello Advisors. Jim, thank you so much for being with us.
Thanks for having me.
Absolutely. So a little bit of a different guest. You work with a lot of companies in the trades, right? Tell us about your company.
So Monatello, we serve about 400 small business clients around the U.S., mostly 1 and 2 owner businesses. So that's kind of our niche is small companies, I would say ranging from 2 to maybe 20 million, 2 to 15 million in revenue, that kind of range, with different levels of capacity and different levels of maturity, in their life cycle.
Awesome. And so what do you help them with? Like what is the scope of work? Yeah.
Um, well, how about can I take just a couple minutes just to kind of share this story because I think it'll kind of create the framework for what we do and how we do it. Is that can you give me a minute
I
or two?
would love that. Absolutely. Yeah.
Okay. So I was actually a contractor in my early 20s. I love the idea of building my own business. At a young age, I had a bunch of trucks on the street, a bunch of guys with my shirts on their backs, and it was very exciting, for a young kid who grew up in a middle class family to see this kind of come to fruition, right? And so I really loved the idea of building a big business, but I hated the uncontrollable variables that I had to deal with, okay, as a contractor. Where the diesel's going to start at 2 a.m. in the morning for the salt trucks that are going out on the street, where guys going to slide into loading docks and break the plows, you know what I mean? And half of, those guys go down, where guys going to show up to work that day. Was someone going to come, to our yard when I wasn't there and offer my team another buck an hour and steal an entire crew away from me, right? All those things happened to me, as a contractor, things that I really didn't have a lot of control over. And
Hmm.
so while I love the idea of building a big business, I didn't have a love for this specific industry that I was in. So I actually left that industry at the age of 30. It's kind of crazy, but I actually joined an investment firm when I was 30 years old. And I found a firm that was willing to take a shot on a young guy that had no experience, but a track record, of success as an entrepreneur. And
Yeah.
so, this is a true story. I took a job for $25,000 a year. Um, I would
Love
have
it.
worked for free. They didn't know that. I would have worked for them for free, but they offered me 25 grand. So I took this job and I started advising banks. I had a degree in finance, so it wasn't a new thing. Math and that kind of stuff wasn't new for me. They taught me how to kind of do my job, and I got really good at it, to be truthful.
Hmm.
Then in '07 and '08, when the credit markets were blowing up, and most of the people on this podcast, their businesses were struggling '07, '08, '09. Some of them probably didn't survive.
Yep.
I was hired by a firm to start a distressed mortgage hedge fund because I had expertise in these mortgage-backed securities that were the actual epicenter of the crisis. So
Yep.
if you
Yep.
look at Lehman Brothers, AIG, Bear Stearns, they all blew up because of mortgage-backed securities. That's where my expertise was.
Hmm.
So I was hired by a firm to start a distressed mortgage hedge fund, and I started working with a lot of family offices. And so family offices are basically families that had a large operating company. They either took it public or they had a private equity buyout. And boom, here's here's a $500 million. Manage it. You move from an operating family to a financial family. And
Yep.
so those were our customers. Those are the people I was talking to. And so I was there to tell them what great investors we were. But I learned a lot about the ultra wealthy during that window of time. And the ultra wealthy in the US are very, very focused on the tax code. I'll bring it around. You'll see in a minute why I'm telling you the story.
Focus on what? Tax code?
On the tax code. That's right. Because they were less concerned. I was all concerned about the top of the funnel, right? Hey, you need to invest with us because I'm gonna deliver a bunch of return for you. What they were concerned about was ultimately
Protect the.
what flowed through.
Yeah.
What flowed
Yeah.
through.
Yeah.
Okay. And so there's two other things that happened in that window. So we took a startup manager, no track record, no nothing. We built it to $1 billion of assets inside of a 7-year window. So it was a kind of a right place, right time kind of situation for me. But
Mhm.
while I was there, I learned about these family offices and what they were doing. And I realized that they were very focused on what flowed through and navigating the tax code. And so I took a shift in my career about 10 years ago from looking to deliver high performance, alpha driven investment strategies to holistic, tax centric financial planning that wasn't for families that were worth a $500 million, but for operating families that are just saying that $2 to $30 million range. So
Mhm.
what we
Mhm.
do is we apply a deep understanding of the Internal Revenue Code, how it intersects with families with complexity in operating company, complex financial assets, and we help them navigate the revenue code to maximize the productivity of their assets. Does that make sense?
Got it. Of course. Um, yeah, personally, my stuff is getting really complex right now. So I totally get it, and the number of K1s and flow through stuff is just actually getting ridiculous at this point. So I totally get it.
And here's the interesting thing: your K1 income impacts the taxability of your operating income from your business. You know what I mean? Those things all move together. You got different dials that you can lever up, lever down, and things like that. And that's why complexity, for our standpoint, equals opportunity.
Hmm. Okay, so you went there. Okay, so 30 years old, you go to this investment firm. You're sort of doing all of those things for family offices. So not for the half a billion, but for the 2 to 20. Um, Eh, so keep going. Like keep going. Is that what you're currently doing?
Yeah, so that's what brought me to Monticello, was seeing what
Got it.
really wealthy families were doing and saying, okay, can we apply something like that to these underserved operating families in that
Got it.
lower income, but in that 2 to 30 million of net worth range?
The lower income, the only single and double digit millionaires
Yes, yeah,
instead of
correct.
nine figures. Okay, I absolutely love it. So you're working with a lot of these, the 400 clients. You're working with them more on the personal side though, right? And the flow through income, because I would imagine a lot of or I know a lot of these small businesses they're LLCs, so a lot of their income sort of passes through, right? And then ultimately becomes ordinary income for them. So I would imagine they are almost in the most need for a lot of those smart ways to minimize taxes, right?
Yeah, so operating families have different types of income, right? So they have flow through income that may be subject to the QBI deduction, flow through income. The QBI deduction, and I don't want to get too technical here, it's the qualified business income deduction. It's a 20% haircut that small business owners get if they can jump through a bunch of hoops and get their AGI down and things like that. So what you've got is different types of income taxed at different brackets. And so the key is to kind of put the puzzle together in a way that optimizes the productivity of their assets and minimizes not just their short term, but ultimately their lifetime tax liability. And that's where I think a lot of CPAs make just gargant, in our opinion, huge mistakes because they say, oh, you need a solo 401k, or you need a defined benefit plan, and we're going to sock a bunch of money away into this defined benefit plan, and I'm going to save you all this money this year. So they save you a bunch of money this year, and they create a tax liability down the road that's 3x of what it would have been had you simply done the right planning in the first place. So it's about looking at the lifetime tax burden, not just the short-term tax burden.
100%. I actually have a story where, I had a liquidity event for my first startup, and we were at, I was at 4 years, so I hadn't hit the 5 years for the QSBS, and
Yes.
I as a 26-year-old kid, basically found the 1045 deferral, and, I'm like, "Why didn't my CPA come to me with this?" I'm like, "Is there anything we can do?" No, 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 no. I'm like, and then I do whatever, and, a bunch of Googling, and then it's like, well, it seems like we can defer it using 1045 into another, Delaware C corp that's an operating company. I carry my clock. I only need one more year. It's like, I was so frustrated because I was like, "How come you didn't come to me with this?" I was like, "I wanna know everything, like, do I go to Puerto Rico?" You know what I mean? I'm like, "Tell me
Yes.
everything." And it might be a bad idea, but, let's look at everything and then figure out what we can do. It's like, I don't wanna just write the check.
Two things to that. Okay. Number one, the code just changed. Okay. And the qualified small business stock now ratchets up
Yeah,
to
you
that
get
5 year.
credit for it
You
now.
get
Yeah,
credit after
yeah.
year 3, year 4, year 5, and you kind of ramp up into it. So it was a really good change in the tax code. Um,
Huge, yeah, we love that.
Number two, there's like an agency dilemma in the accounting industry. Okay. So your CPA charges you $1,500 to do your corporate tax return, and whatever he's charging you to do your personal tax return, and boom, he or she processes a bunch of information and outputs a return and puts it in your lap. That's very different from comprehensive tax planning.
Yeah.
And the knowledge and the time requirement to optimize that tax return, number one, it needs to happen in the prior year. It can't happen on April 15th. April 15th, your bed's already been made. Okay. Number two, most of these firms don't really take the time to dig deep enough because they don't think they can charge you for their time. Okay. To justify the tax savings. And that's where we think they're really missing the mark.
Yup. Um, yeah, now things are different. Now I have a whole team. It's like a baseball team on it. But yeah, I totally get the pain point and the problem, and especially for these guys that are pulling in consistent, a lot of our customers are pretty big. I just got off of I literally just had a podcast right before this, and the guy's doing 18 million in revenue, profitable. Him and his partner are pulling out, probably 7 figures each personally per year. Um Again, flowing to them, and if they didn't set things up like as ordinary income. They're in California,
So,
highest tax state.
yeah.
You should actually talk to them. I should make an intro, but yeah, tell me about some of the pain points that your customers are seeing, and some create not create just some stuff that you're doing to help them out. And what are some wins? Like, I want to hear problem, pain, and then a massive value add.
I think I think one of the bigger challenges that we're seeing now, especially in the trades, is, I don't want to be sexist here, but mostly guys, in their late 50s, mid 60s, want to exit, don't know how to exit, set up their business around themselves. Their business revolves around themselves. They don't have a succession plan. They don't know how to transition the business.
Yep.
And I just think there's an enormous opportunity for good counsel there. We call them exit ready businesses. Exit
Hmm.
ready businesses. We've got like 6 stages that we take them through to get them ready for exit. And then once they're ready for exit, they have an option. Okay. Once the business is ready for exit, they can treat it as a financial asset. because they've got a management team in place to manage it. They can treat it as an asset they can transfer down to the next generation if they want to give it, to the next generation. They can treat it as for sale, you know what I mean? And once they're there, then they have the option. I want to continue to operate it. I want to give it to my kids. I want to just run the cash flow, or I want to sell it, right? But you've got some steps that you need to take to get there to deleverage yourself from the operating company so that that cash flow is repeatable without you, because no
Hmm.
one's going to buy the business if the next buyer thinks that it's 100% dependent on you being there.
Hmm.
Does that make sense? And so what we'll do is we'll step in and we'll say, okay, where are you guys strong? Where are you weak? What can we do to come alongside you? Okay. Are our books in order? There's a bunch of steps. We assess the current state of the business. We identify, okay, is there an ERP system in place? Is it the right ERP system? Document the processes in the systems, optimize the resources, the operations with financial planning and advisory, enhance the revenue streams, strengthen the team. So there's steps that we take. We start with the lowest hanging fruit and we move up there until these businesses are in a position where they're ready either to be transferred or be treated as a financial asset.
So I'm so curious. So I know that there's tons of talk, and logically it makes sense that, the owners are aging out, and there's succession plans, but from everything that I've talked to, everyone's buying, no one's selling. Like, I even did, send out to our newsletter. We have over 11,000 SMBs on it. Everyone wants to buy. Everyone has capital. Everyone has a search fund. Everyone wants to buy, and like no one wants to sell yet. I think everyone loves that there's the option to sell, but everyone's like, "Oh, I'm not ready yet. Not ready yet. Not ready
Yeah.
yet." So I'm curious, like how big this actually is with this succession transition. Owners don't know who to go to because it feels like it's more of a dream and more of hypothetical than what I'm just personally seeing. Like, I'm curious, like your thoughts on that.
Um, well, your team had asked me to talk a little bit about private equity, and that's obviously, you know,
Yep,
one of the exit strategies. So if you want to spend a couple minutes there, I can give you my thoughts on that
definitely.
and how that intersects, with your group of business owners, right? Um,
Absolutely, yeah.
so when I think about private equity entering this space, here's kind of the executive summary. It's good, but okay, it's a
Yep.
big but. Okay, so if you'll give me a little bit of latitude, I want to kind of build a conceptual framework for around private equity, and then I'll bring it around to your question: is how does it impact the people who listen to your podcast? Is that fair?
Mhm. Yeah,
Okay.
love it. Yep,
So
perfect.
so, so there are two self-perpetuating myths that exist in private equity. And as long as they continue to exist, there will continue to be money flowing into that space, and there will continue to be liquidity
Mhm.
opportunities for successful business owners. Okay. But
Yep.
let's first lay out the framework, right? So why does private equity want to be in this space? The
Yeah.
financial
Yeah.
appeal is the reoccurring revenue, right?
Mhm.
Service contracts are highly profitable, high margin, robust cash flow without a lot of upfront investment, right? So it's about the cash flow. That's why they want to be in this space. Number two, it's highly decentralized. You have some regional service providers that they can maybe bolt on, they can take on as a platform company, and they can bolt in some underscore, around them in build out. And there's a perception in the
Mhm.
PE space that there's opportunities of scale, there's operational efficiencies. I don't buy that at all, but we'll come around back to that in a second. So it's a fragmented market that they believe is scalable. Okay, so that's why private equity wants to be in this space, because of the cash flow. If
Yep.
if you look at the life cycle of a fund, okay, you're talking about 8 to 12 year. You're talking about an 8 to 12 year life cycle. You got 6 to 18 months to raise the money, 2 to 3 years to source the deals, to put the money to work, 3 to 7 years to harvest it, acquire the platform, roll up, operational efficiencies, put them all together, and then exit. And so the key piece to this is that the life cycle of a fund demands an exit. They all have to exit because it's not proprietary capital. And so you're seeing big changes going on right now in the PE space that I think is relevant. It's not super relevant to these smaller companies that are probably listening to this podcast, but it's relevant long term, right? So the biggest investors in PE historically have been pensions and endowments. They represent
Yep.
about 45% of the investors in that space.
Yep.
Um,
Yep.
there was a guy named Dave Swenson, I think. He was the head of the Yale Endowment. He was wiping the floor with the performance of all other endowments. And so he wrote this book called The Endowment Model. And all these big Ivy League institutions jumped on that and they jumped into private equity. Okay. So they all jumped into private equity over the last couple of decades. And now you're seeing a shift because Harvard and Yale are now selling off billions and billions of dollars of their PE pieces because they're starting to
Mm-hmm.
get taxed. They've got federal research grants that are getting reduced. They got higher
Mm-hmm.
operating expenses, and so they need liquidity. So they're now becoming net sellers, not buyers, okay,
Interesting.
of these
Yeah.
funds. This is really important. You've got to follow the money, okay?
Mm-hmm.
And so
Mm-hmm.
they don't have the cash flow that private equity's been promising, and so they're turning to the secondary market, and the secondary market now is bidding this stuff at 60, 70, 80 cents on the dollar, may not take it off their balance sheet. But what these private equity sponsors are now looking to do is they've got to find new dumb money. Okay. If you're a professional poker player and you want to make money, the best thing you can do is go find weak tables, right? Find dumb money at weak tables and go play there. You play there long enough, you're going to make money. You won't make money every day, but you're going to make money over time. It's the same thing in the PE space. They've got to find new people that are going to enter the space. So they're now launching these retail funds. This is for real. Okay. They're trying to get into the 40x space. They're trying to enter the retail space so they can have a new supply of cash. Okay. And as long as
Yep.
there's cash, they're going to have cash to put to work. Here's what's really important. There's two big misconceptions about private equity. Okay. Number one is that these private equity sponsors are great operators. Okay.
Yeah.
We're gonna take a 51% interest, in the company, and we're gonna put on our three Ivy League Matt's from Harvard, and Joe's from Columbia, and Steve's from Wharton, and they're really good, and they're gonna help you run this company better than you can. Okay, that's
Yeah.
totally absurd. It's totally absurd that a couple of Ivy League educated business school grads are going to run a business better than an operating family has been running it for 40 years. Okay.
It actually pisses me off when I hear that, and I hate when people talk down about people in the trades. It's like these guys are actually way more sophisticated than you think. It's not like ye honky tonk in a van. It's like these are like legit companies.
Yes.
They're doing 10 to 50, $100 million a year printing cash. They're not, it's like real.
Yep.
Yeah.
No question. Okay. So can these PE sponsors, find cheaper labor? Are they better equipped to train their labor? Are they gonna be able to buy trucks cheaper? Are they gonna have cheaper rent? They do not operate these companies better than the families do. But there's a myth that
Right.
but here's the
Yep.
here's the key piece. Okay. They lever up these balance sheets. So they don't run them better, they lever them up. So you got a company doing 10 million in EBITDA. They sell out for $100 million to some PE fund. That PE
Mhm.
fund comes to the table with 50 million equity, 50 million in borrowing, $100 million, liquidity event for the seller. Now you
Yeah.
got a balance sheet that's 50% levered, and now a third of your cash flow, your free cash flow, is just going to pay down debt service, if not more, right?
Yep.
So
Yep.
because they're levered up, they can't continue to reinvest the way they've reinvested in the past because all they're doing is servicing their debt and trying to pay the debt down. So that's myth number one. Myth number one, that PE sponsors are better operators. The data does not bear that out. Okay. Myth number two is that private equity funds have less volatility than the public markets, which is absolutely absurd. Okay. Let me just, I'll just share this really quickly. The average company in the S&P 500 is probably $100 billion company. The average company in the Russell 2000 is probably around a $2 billion company. And the average private equity acquisition company is probably somewhere between 250 and $300 million with 50% of its balance sheet levered. Okay. You tell me how that little micro cap company with 50% leverage on the balance sheet is going to have less volatility than the S&P 500 $100 billion companies with a fraction of their balance sheet as leverage. Okay. And
Yep.
so this is another myth. And it's a myth because these companies are not marked to market on a daily basis. You buy them. Oh, I think it's worth 300 million. Oh, you know what? I think it's worth 320 million. You know what? Let's meet in the middle. We'll mark it
Yeah.
at 310. Okay. They don't.
Even now, it's like the cash flow multiples, like it was, 3, 4x for like, sub 5, sub 2 million cash flows. But now there's so much just demand and there's less supply that it's like even the cash flow multiples for the smaller guys are like becoming like 5, 6x now, even at the smaller end. And it's like just so arbitrary. You know
It's
what I
totally
mean? It's like
arbitrary. And what
so arbitrary. Yeah.
when the mark is arbitrary, you can keep your volatility really low because you just decide what it's worth, right? So it looks like
Yep.
you're running a fund that has no volatility. I'm sharing that because these two myths about PE sponsors being good operators and private equity in general having much lower volatility in the public markets are simply not true. And that's starting to get exposed. Okay, if you read anything from like Cliff Asness from AQR, a big alternative manager, super sharp dude. He talks about this all the time. If you Enos Knupp is a huge institutional consultant, and he's writing about this. Richard Enos is. So it's the information's out there, and as the universe starts to get more exposed, then they're at risk of not being able to raise more money. When they can't raise more money, then there's no more liquidity events, for the people who are in that space. So I think it's important that your listeners understand that the changing tides of private equity and how they impact the capital structure when the business gets acquired.
Hmm. Yeah, that's so interesting. I also see, and even SBA loans. I think now we're talking about like debt and all of that, but even on the smaller end, like the SBA loans, that's leverage. That's debt that's essentially has to get serviced. And I think a lot of people look at it as, oh, I can get a company with nothing down, little out of pocket. I'll have some, GP, equity, but then I pretty much, seller note. I'll have a SBA loan, and then they get into these things, and it's like sort of there's no room to breathe because everything's going to service the debt and the seller note. And they've never ran an HVAC company in Tulsa, Oklahoma before, especially at any type of scale. So that's really interesting. So of your 400 clients, are most of them in the trades? Like what kind of industries are we talking about?
A lot of contractors,
Yep.
um, some restaurants, and just some regular service businesses. So we're seeing more and more trades just because we're getting more referrals. Do you know what I mean? We're just getting
Yeah.
referrals from our people in the trades, and so we're starting to kind of niche down to that target market over time.
Yeah. I think it makes sense too, because a lot of these guys are in kind of these like hush hush group, not hush groups, but like kind of like off, they're in like private groups where we just did a webinar to a subgroup of a organization called Service Nation that we were introed from one of our biggest customers, $30 million HVAC company in Appleton, Wisconsin. He's like got other companies same size, and he's like, hey, come to this group thing that we're doing. And I don't know, there's just a lot of and it's interesting. Me and my tech friends have sort of like private WhatsApp groups where we'll share deal flow, and it's like similar with these guys, and I think it's actually an interesting way to acquire new customers is sort of in those kind of like off the beaten path groups and
Well,
channels.
well, it's also,
Yeah.
like when you do an ERP search for a company and you're trying to figure out what's the best solution, you learn a lot, right?
Yeah, yeah.
Next time someone comes to you, you already know kind of the five major vendors, what their strengths are. You know what I mean? And you've done half the work because it's already internalized. So
Mhm.
there's some scale advantages to serving, a smaller base of clients.
Absolutely. So as you're, are you? ever going to other people within the organization? Like, if you're the owner, like, do you ever serve? I guess probably not, right? Like, you're never also like the COO and CFO and their family, or are you pretty much like one person per org?
Um, it depends. So, when we look at kind of the 8 different steps of the value chain that we can play a role in, you know, there's some that we play a role, in 5 of them, but not 3 of them. There's other where we just do one piece. So some firms will come to us. They already have a CFO, so they don't need like an outsourced controller, outsourced CFO role. They don't need the FP&A piece. They need the tax piece, the
Yep.
tax prep piece, and the tax planning piece, right? Other people will come to us, a little $2 million shop. Hey, my in-house bookkeeper just quit. I need someone, to take over my QB, my QuickBooks Online account and pay their bills, pay our bills.
Yep.
You mean so it just depends on what the needs are and where the strengths of their team are. We try not to squeeze people out of spots. We try to just move into spots where we think we can add the greatest value.
Yeah, that makes a lot of sense. What's I gonna say? Yeah, it feels like, a lot of these, like, again, I just got off a call with a guy, 18 million, wants to go to 100 million. I think so many people are so focused on their businesses, myself included, that you kind of are like, well, if that does happen, I guess personally, I'm going to also be bringing home a lot. Like, they forget to almost do the stuff personally, um, to like set themselves up for success. And I think that's where you come in. You're like, guys, you're growing your business and you have a clear path because you know what you need to do with your business. But like, don't, spend the couple hours with me meeting, getting the things kind of set up, so that you can protect millions of dollars in personal take home income that otherwise is going to go to the government to essentially probably not spend efficiently.
Yep.
Via tax dollars.
Yeah, we try to break things down, keep it super simple, right? Elegant solutions have simplicity to them, right? And so
Mhm.
we look at it in the context of 3 different buckets. Okay, you have assets in three buckets. You got your pre-tax bucket, which is your 401k, your IRA, your pre-tax money. You got your post-tax money, which is your operating company, your real estate, your brokerage account, and then you got your never to be taxed again money. This is bucket number 3. That's your Roth IRA, your Roth 401k, your cash value life insurance, things like that. So we break it
Yep.
down into those 3 buckets, and then we say, okay, over the course of your lifetime, you're going to pay X in taxes based on what your balance sheet looks like today. How can we shift the chairs on the deck, okay, between the 3 buckets? Maybe we pay more tax up front in the first couple of years,
Yeah.
and then we save hundreds of thousands, maybe more, over the course of your lifetime. Maybe we shift portions of this into, a slat or what. I mean, again, there's 1,000 different ways to go here, but the key is
Yeah.
to not just focus on how do I save money between now and year end. It's how do I set up my finances to navigate the Internal Revenue Code to maximize the productivity that ultimately flows into my balance sheet and what's going to, in the end, flow to my children, my kids.
Yep. I love storytelling. I also love positioning it, where there's like emotion. Like I love that flows down to my kids. It's like yeah, I love all of that stuff. Cuz I think it puts it into context. I think if you just talk money, taxes, it's very like stale. Like it doesn't feel, you don't feel it, but when you kind of speak to it in storytelling terms, I love it. It makes me feel good. Okay, so let's wrap up here. What when a client comes on board, like what's your process? What's your onboarding process for a new client? And you know, I'm sure it varies obviously by client and scope, but like what does it look like to sort of get onboarded and to get your ducks in a row, as they
Sure.
would say?
Well, again, it depends on what level of services, right? So if it's just simply, hey, Sheila's struggling with my new person, took over the back office. She doesn't know how to run payroll. Can you take over payroll? Okay, so then
Mm-hmm.
we have a payroll onboarding process to take that burden off of their plate so they don't have to worry about that, right? So what do we need? Okay, we need, this information from each employee, blah, 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 their bank information, all that, right? We onboard them, we get that set up. If it's a pure bookkeeping client, right? Okay, are you on QuickBooks Online, or what's your accounting tool that you're using? We prefer QBO for most of our small to mid-sized contractors because there's a tech stack that we can build on top of that to automate a lot of that work. And so a
Yep.
lot of the work that a lot of these, and here's the other thing we find with a lot of these contractors, they've got good people, they've got reasonably smart people, but they've also got people that have been doing the same thing since 1998, using the same
Hmm.
technology from 1998, right? And so we find that if we update them to a current tech stack, maybe QBO with bill pay and a few other things, a lot of things that were being done in the past can now be automated, and we can give them real-time views, real-time tools that can help them, navigate their business better. So we definitely prefer QBO. We definitely prefer automating the tech stack on top of the QBO so that we can give them a real-time view of what's going on.
Amazing. Amazing. So where can people, is there anything else there?
Well, again, it just depends on how we're coming alongside them, right? What are
Got
they
it.
looking
Yep.
for from us? So we've got our we can do the what I would call the processing work, right? We can run your
Hmm.
payroll, we can keep your books current, we can give you good financial statements, we can give you tools, but the real
Yeah.
value add is how are we using those tools to maximize the productivity of your assets? How does the flow through of this K1 income impact
Yeah.
your tax on your 1040? How is it, the revenue from the property that you're renting from, right? How does that impact the QBI deduction on your operating income? Those are the
Yeah.
areas. Do we need, a 401k, or what should we be doing with the 401k? Should we put it in the Roth bucket or the tax deferred bucket, right? What does the balance sheet look like? What kind of income are we going to be generating in retirement? Right. And so all those things need to come into play when you build
Yeah.
a comprehensive plan. So it's like, people come to me and they're like, oh, it's like I'm a doctor, and they got a headache, and like, oh, doc, just give me an aspirin. And I'm looking at this freaking, thing bulging out of their neck. Right. I just give me the aspirin. Just give me the aspirin. I'm
Yeah.
like,
Yeah.
I give you the aspirin, but we might want to take a look at what's
We
going.
got to do surgery.
Yeah. So, anyways, the more complex it is, the more opportunity there is to apply a deep understanding of the revenue code to their situation and then maximize the outcome.
Love it. Love it. Yeah. And if I'm sure most of the business owners are like me, it's like, those are a lot of words. I'm going to let you do your thing. Make it so I have to pay the least amount of taxes. I can maximize, using the revenue code and everything's super buttoned up and legit. But, you know, do your thing. That's kind of like how I feel. It's like I want to focus on what I want to focus on. It's like, sure, I'm sure some clients probably, maybe some of them want to understand it deeper, and then some are probably like, I trust you, sort of like, do your thing, let me know what you need from me. But like for me personally, it's like I almost don't want to like get too deep in the details, because it's like that's not what I'm great at. It's like I want to focus on like my business and maximizing my top line, and you help me protect my bottom line. Boom, we'll grow the whole thing bigger and bigger together.
Yep.
Love it. Jim, thank you so much for being here. I've really appreciate it. Where can we find you?
Go to Monotelo, Monotelo.com. You can email me directly, jim@monotelo.com. Happy to connect with anyone that, would like some, direct interaction. So we're here to help.
Absolutely. And we'll have Jim's contact information and website in the show notes on all platforms. Jim, thank you so much for being with us. And I actually think a ton of our customers and listeners are going to be like, yeah, that's me. So I think you'll should probably be getting some inbounds from this. But Jim, thank you so much for being with us, guys. It's another episode of the Share Willow podcast. Thanks, Jim.
Thanks, Ryan.